Hello everybody. Uh, Welcome to Cinema Investing Stock Market Masterclass. I will be your lecturer from here. Uh, Let me briefly introduce me first. My name is uh, Manusha Ranavaka, and I will tell you uh, my qualifications to teach you. First of all, to teach a subject like investment, academic qualifications are not required. You have to become an investor to teach investment. So you have to become a investor. So what is the meaning of becoming an investor? If you want to become an investor, you have to have a capital. You have to have a capital. You have to invest your money in stock markets, and you have to have a sufficient return to invest in stock market, invest in stocks, and you have to have sufficient return, so you can live from that investment return, so you can call the investor. So I am an investor. I have invest millions of US dollars in the stock markets and my other investments. So I am uh, experience wise I am qualified, practical wise I am qualified to teach you. And also I am investing in stock markets for like 14 years 14 years. So I have 14 years of experience in this subject. But uh, I'm a Sri Lankan. If you are listening from India, or if you are listening from a Western country, uh, my accent will be different from yours, but don't worry. If you forget that and listen carefully, you will be attending the world best investment class. So my academic qualifications are: I'm a BSc financial special graduate at University of Sri Jayewardenepura, Sri Lanka. So these are my basic qualifications to teach you. Uh, so I will move to our first lesson. So this our material will be different from what you will be learning in YouTube and other social medias, because most of those materials are wrong, mixed, and if you follow those materials, you will be fail. So first of all, you have to identify uh, the activities present in the stock markets. The activities present in the stock markets, or people who participate in stock markets. So there are main two types of people who let's say three types, but mainly I will divide them to main two types. These things are not taught in university, so listen carefully. You only listen these things here. First category is investors. Uh, Investors means you invest money in a company, uh, so you can have a business relationship with such company, let's say ABC company. And also if you are listening from another country, let's say migrated Sri Lankan or Indian, or you want to invest in Japanese stock market, Indian stock market, USA stock market, Sri Lankan stock market, theory is same. You can apply the concepts we teach here in any stock market, and you can success, and you can gain millions of capital, and you can become financial freedom and retire. So investor means a person who invests in stock market for a return with a business relationship. Other category of people are traders. So traders are people who trade. They don't have business relationship. They are not interested in equity relationship with the company, but what they do is traders and speculators. So what they do is they buy, let's say ABC company, they buy a share for, let's say, 50 rupees and they try to sell it for higher price. They buy a share for 50 rupees and they try to sell it for higher price. That's what speculators do. So in this class, this area is not teach to you. We teach this trading area in our cryptocurrency masterclass. So if you are interested in that, we expect and we invite you to join that also. So what traders do is they try to predict the price. They think now share price is 50. They try to predict the share price. So they think now share price 50, it will go to 60, 70 like that and go above. So they buy 50 and wait, thinking the share price will move. So they use some techniques for analyzing and they think share price will move. But investors think oppositely, and in our school of teaching, so I want to clarify you what we teach first. What is the school we in our school of our cinema investing class, we teach the best content. Best content means we teach the content which is taught by billionaires, how the billionaires made their capital. So there is 99% population, 99% 9 population, and there are very little rich people. No? So we are teaching teaching how rich people think. Now rich people don't think this way. Rich people means investors. Investors don't think this way. So I invite you to buy the book Intelligent Investor. Intelligent Investor, or you can download it from Google and you can read the book also. It is written by Benjamin Graham. It is called the best book ever written regarding investment. So you can buy the book also, or you can buy a physical copy, or you can Google download the PDF copy and you can read. So why this book is important? You know, Warren Buffett is the world most wealthiest investor. So he recommend this book. He says he made his capital according to this book. So we are teaching this book. So you think the value of this class. So in this book they teach some content. We add some content also from other billionaires and some mix we teach. In this billionaires philosophy, they do not believe this kind of things. They buy 50 and predict the price and sell 100. They do not believe. They believe this is not possible. The reason is, if you can do this, let's say if you buy 50, sell 100, you can predict the price. Let's say if you put, let's say 100,000, let's say 10,000 USD if you put, or let's say if you put 10 lakh money, anyone can find 10 lakh. If you put 10 lakh, let's say you double it, predict the market and double it, 20 lakh, predict the market and double it, 40 lakh, predict the market and double it, 80 lakh, predict the market and double it, 160, 320, 640, let's say 1000 and so. Let's say 1300 something, 2600 something. Likewise, if you can predict the market 1, 2, 3, 4, 5, 6, 7, 8 times or 9 times, 9, 10 times, let's say it's, if it is possible, predicting the market, if it is possible, share markets are fluctuating most of the time. It's going up and down, 50%, 200%, 100% movements going up and down. If you always, if you can buy low and sell high, if you do it 10 times, if you do it 10 times accurately, you can become a billionaire. If this is possible, everyone who join the stock market will be billionaires. So you know it is not the case. So you have to think opposite. You have to think this is wrong. This approach is wrong. So billionaires do not approve this approach. So you have to identify that. So normally what Warren Buffett or any billionaire recognize person try to do this thing is a stupid activity. This is a stupid activity because this is not possible. Market fluctuate randomly. There can be millions of reasons for the market fluctuations. So it fluctuates randomly. You don't try to predict the market. So trying to predict the market is not investment. It's called speculation. It's a separate subject. So if you want to try to predict the market, it's not very easy. If it is so easy, everyone will be billionaires. 10 times if you do that, you will become a billionaire. You know there is no such amount of billions, only 2,500 billionaires, US dollar billionaires in the world. So you know this is not possible. This is not possible. If this is not possible, what is the correct way? So Warren Buffett didn't try to do this. When he started the business, he told one interview when he was age 12, he tried to do these things, 4 years, failed and learned what this book says, written by Benjamin Graham. Warren Buffett teacher is Benjamin Graham, and thought opposite, and he made a huge capital. So this is not the way you think. If you think this way, this is very easy, I can predict the market, and if you try to do this, you will lose. Okay. So what is the correct way? What is the correct way? So I will cut this by a big cross, red cross. You don't write this. So what should a investor do? What should an investor do? Investor, we teaching you investment. This is the basics. What should investor do? So investor do not try to predict 50 to 100. That is clear now. No, this is wrong. So let's say ABC company share price is 50 rupees. 50 rupees. So what an investor try to do? So let's say 100 rupees. Or is, let's say round number 100 rupees. ABC company share price is 100 rupees. What investor do is, now this course, remember this course is not a beginner course. So I believe you have the skill to navigate the systems. I mean, let's say A-Trade system, direct FN system, any system in your country what you use, you can buy and sell shares. What you don't know is, you don't know how to profitably do this. How to analyze shares, how to strategize your portfolio, those things you don't know. So that's, I am here to teach. I am not teaching you how to buy shares, how to put an order, how to close the order. Those things you can learn from your broker. So this is a strategic level class. So I am teaching you how to become an investor. So I am an investor. I am living from investment income. So I am the best person for you to teach this. I retired like age 27, very young age. So I am the best person to teach this. So what investor tries to do is he tries to calculate. He tries to calculate, evaluate, calculate or evaluate what is the value of the company. So what is this 100? 100 is share price. Share price we all know. Share price you know this. Right? Share price you know. So what investor try to do is he try to value the company. He try to value the company. When trying to value the company, investor have few tools sets. So in this class our main focus is how to value a company and select a company. So investor have few matrices to value a company. So there are industry based valuations, there are ratio based valuations, there are, when I am talking please you take notes, don't passively listen to the lecture, you have to take the notes properly, you have to take the notes point form properly so you can learn it very well. There are many kind of valuations. So you can have cash flow valuation, ratio based valuation, industry level valuations, or dividend based valuations. So there are many valuation types. So let's say after, so we will teach how to do these valuations in future in this class. But for now let's assume you calculated ABC company value, let's say cash flow based valuation. Cash flow based valuation is the most correct valuation. Cash flow discounting valuation, this is the most correct valuation out of, let's say, industry based, ratio based, dividend based. Most correct valuation is cash flow based valuation. Let's say you have calculated very accurately share value is 50 rupees. 50 rupees. So as an investor, will you buy this share? The share price is 100, share value is 50 rupees. Will you buy this share? Of course no. If you buy this share price, you pay 100 but you get a value of 50, you get a negative. So inside brackets means in accounting terms it's negative, okay? It's a loss. When I show you the financial statement, numbers inside the bracket means you have to learn lot of content to become an expert investor. The numbers inside bracket means it's a loss, so negative number, like that you remember. And also what is this? This means thousands. So in financial statements, so if you want to become an investor, you have to read financial statements. They are uploaded in where? In Sri Lanka they are uploaded in CSC website. In your country I don't know, you have to find out and download the financial statement and read it. So there are so many numbers, most of the numbers presented in thousands. If thousands, they will put a mark like this in the top of the financial statement. So this become, don't think this is very complicated, this is very easy, I will guide you through this. It's not a very hard subject. So let's move into the calculation. Our calculation, if you, the share value is, share price is 100 and share value is 50, what you get is negative, so you don't buy. Simple as that. Don't buy. So what if when you calculated the value This is scenario 1. You don't buy. Scenario 2. What if the company share value is 150? From your cash flow valuation, you got 150 value. So will you buy this share? Yes, because you get positive 50. Positive 50. Yes, you buy. You get positive 50. This is the basics of investment. So I will summarize it. You do not try to predict the share price 50 to 100. You can't predict. Stock price movements are random. There is a theory called random walk theory. So you don't try to predict the share prices. If you don't do trading, if you want to become an investor and have financial freedom, you want to have a investment portfolio. When you select in stocks, you don't try to predict the share price. You try to calculate, evaluate or value of the company and cross check it with the share price. So share value is higher than the share price, you buy. Share value is lesser than the share price, you don't buy. Simple as that. So if you can understand this thing, at least I think you know investment. I mean theory correctly. This is the basic theory behind it. So now I am moving to the book Intelligent Investor. This is the first chapter. So its stock is not just a ticker symbol or electronic blip. Ownership interest in actual business with an underlying value that does not depend its share price. When you read the book directly, you will not understand. But after you listening to our lesson, you understanding these things. This market is a pendulum that forever swing between unsustainable optimism, which makes stocks too expensive. Too expensive means value 50, price 100. Simple as that. So you may be not getting because my picture covering. So I move my video to the left side. So so unjustified pessimism, which makes them too cheap. Too cheap means what? Share price 100, but share value is, let's say, 150. 300 value, you get 400. You buy or not? Yes, you buy. Simple as that. So secret to your financial success is inside yourself. If you become a critical thinker who takes no Wall Street fact on faith, you will invest with patient confidence. You can take steady advantage even the worst bear markets by developing with discipline and courage. You can refuse let other people's mood swing govern your financial destiny. So you don't take other people's advices, brokers' advices, your friend advices. You calculate the share value and buy or sell your shares. Simple. It's very simple and straightforward. But problem is why people not becoming rich? The reason is, what's the reason? The reason is why people not becoming rich. Reason is they do not follow. 99% people who are involved in stock markets do not follow these rules. Only 1% follow. So they success. Make huge capital like me. Invested millions of dollars in stock markets and made their retirement very early. Young age. But 99% fail. Why? They try to predict the markets. They don't try to value the company. That is the main problem. So next we are moving fast. Okay. So you have to summarize those things and write down in your book. So you can study later. So next session is second one. Let's say second one. What you should expect? What you should expect? Can you expect you invest, let's say 10,000 rupees today, and next year can you expect it become 1 million? No, you can't expect, but those kind of things happen in the markets, but you can't expect that. So I will explain you what is the average expectation. If you can, let's say, can you expect if you invest 10,000 rupees and can you expect 100,000 LKR in next year? No. So what you can expect? Let's say you invested 10,000 LKR. Reasonable expectation is 20 to 30%. Let's say 10 to 30%. 10 to 30% return after inflation. This is the return of stock market. After inflation. This is very important. After inflation. Now you may be thinking in Sri Lanka bank interest rates are, let's say 15%, 20% like that. So what is the meaning of you are investing in stock market? So this is useless. No. That's why I called you this is after inflation. So bank interest rate is with the inflation. So I will explain you this in the next session. So if you invest in 10,000, you can expect like 1,000 rupees per year or 2,000-3,000 rupees per year. So pretty low, no? You think this is pretty low? No, this is not pretty low. So what is the average return? Let's say if you invest 30 years, 40 years in your lifetime, what is the average return of best investors? Warren Buffett only made 20% a year, but became a billionaire from 20%. Can you believe? 20% a year, but he became a billionaire. He started from zero. Peter Lynch, world best unit trust investor. He made only 29% a year. So long-term sustaining returns over, let's say 15% is very difficult. Very difficult. So you may be thinking this is pretty low. No. Why no? So there is a miracle happening. There is a miracle. What is the miracle? It's a surprise. So miracle. This miracle is called 8th miracle in the world. What is this miracle? It's called compounding interest. Compounding interest. Compounding interest. What is compounding interest? What is compounding interest? So I will teach you this miracle. Compounding interest miracle. So let's say you are a person, you want to become a billionaire. Say LKR billionaire. We are living in Sri Lanka. If you are living outside of Sri Lanka, no problem. You calculate that from your currency. Let's say you start from zero. From your salary, you decided to invest that in stock market. As after you doing our class, you know it's 20%. You think now you think this is pretty low. 20% is pretty low. But after you learn this class, you know it's very huge amount. I am going to teach you this. This is a miracle. So monthly contribution 10,000. Now you are going to invest 10,000 LKR monthly each month next 30 years. This month 10,000, next month 10,000. So for 1 year, let's say 120,000. Total 30 years. Let me calculate. So let me calculate. You may be thinking 1 year 120,000, for 30 years I may be collecting 3.6 million. With interest 20%, maybe it will be around 10 million. That's how you think, no? But I have this compound interest calculator. That's why I call this is a miracle. We set these numbers in this calculator. Monthly contribution 10,000, length of time 30 years, estimated interest rate 20% annually, and I'm going to calculate this. Do you believe in 30 years you will have 141 million just invest in 10,000 per month? 141 million. This is how billionaires in world made their capital. They do not try to predict the market and lose. They value their companies and use compounding effect. They learn, they join these kind of courses, and they learn, they allocate 50% time for their learning, and they invest these kind of companies in stock markets, and in 30 years, even 10,000, very little investment, if you done this consistently over 30 years, you will have 141 million. 141 million. This is how compounding interest works. This is the magic. Let's say estimated interest rate 30%. It will become 1047 million. 1047. You are a billionaire. Even little 10,000. If you invest 30 years. 1047 million. See the difference. See the magic. See how world billionaires are becoming rich. Dhammika Pereira once said he only expect 20% return. This is the reason. When you going to try to predict the market and you lose, you take advices from fake people in the Facebook. You take advices from your broker, fake people. After you lose. But billionaires are becoming rich every day using compounding interest. Using compounding interest. This is the magic. This is the magic. So, now you understand. Earning 20%, 30% is not a small amount. It's a huge amount. If you do it consistently, if you invest consistently, if you invest, let's say half of your salary, 80% of your salary for 30 years, you will have huge capital. You will come to top 100 billionaires in Sri Lanka. You can come top 100 billionaires in Sri Lanka. If you just invest 80% or 50% of your salary. Simple as that. So why people don't try this? Because they are not focused. They are not learning. They are not joining courses like this. That is the problem. Do you believe or not? 100 plus Sri Lankan top company owners are with our class because they understand value of our class. You just learn tiny bit of knowledge what we know in our channel, but you can learn massive amount, 10,000x of knowledge in our private classes. That's why we ask you to join here. So, now you understand what to expect. 20%, 30%, enough. This is what? After inflation. I explain this later. Why it is after inflation. Why it's not before inflation. I will explain it later.